the hiring rate is extraordinarily low. If you don't have a job, it's very, very, very difficult to get hired right now. However, if you do have a job, we're seeing still a record level, low level of layoffs. So there's not a lot of layoffs, but there's no hiring at all.
The Dow fell another 500 points on Monday as Trump announced 25% tariffs on Japan and Korean goods. The Trump administration is now also sending tariff letters to approximately 12 countries. And with major trading partners like Japan, the EU, and India scrambling to finalize deals, today's session could set the tone for how markets handle this next phase of trade negotiations. What's next for trade? What's next for the labor market? How will the labor market react to ongoing trade negotiations and uncertainty? And how will the economy fare in the second half of 2025? Eric Basmajian is going to break this down with us today. He is the founder of EPB Research. You can find his research in the link down below. He also runs a great YouTube channel. YouTube channel is linked in the description down below as well. Check that out. Eric, welcome back to the show. Good to see you again. Happy return to work after the 4th of July, as many of us are.
Yeah, good to be back. Thanks for having me on. And certainly a lot has happened over the last couple of weeks. We got some more tariff announcements. We'll see how long this one lasts, but certainly a lot going on.
Tariff announcements have somewhat simmered down, and it seems like the administration is back to work on today, on Monday, because we haven't heard anything last week. We haven't heard anything the week before, but now the Monday after the 4th of July, things are back in full swing. A lot of volatility today. The S&P, like I mentioned, is down. The Dow, like I mentioned, is down 500 points. The S&P is down 1%. Gold's flat. The dollar is up, interestingly, 33 basis points. Treasury yields, 10-year yield is up 1.5 or 1.1% rather. Crude oil jumped almost 1%. So I think let's just start from, tariffs and what this means to the markets. What can you tell us about what you've seen so far about negotiations with other countries? And my broader question is whether or not this is uncertainty that's here to stay, or like I mentioned to you offline, I was joking to you offline, perhaps this is just a buy the dip opportunity. Every time we see a tariff announcement, every time something crashes by 1%, you just buy the dip because that's worked out well in the last 6 months or so.
Yeah, hard to argue that strategy hasn't worked out pretty well. I don't have any special insight into how the negotiations are going to go, so I'll just address tariffs from a high level. So
Sure.
when you impose tariffs in its simplest form are a tax. So they have to be absorbed by somebody. Now, there's a debate as to who exactly absorbs them or if they're spread out across multiple parties. But whoever bears the brunt of the tariffs has a negative effect because the tariffs are a tax. So if the tariff level is ratcheted up, that's going to be a negative for the US and global economy in the final analysis. So when we go back to April, we had these huge tariffs that were announced, and the market started to crater because these were huge tariff levels, which amounted to huge levels of taxation essentially on various participants. And it was pretty clear that if those tariff levels were sustained, it was likely to put the economy into a recessionary environment. There were ports that were frozen and all the rest. Those tariffs got walked back, pretty aggressively to the point where the market almost assumed that there was going to be no tariffs at all. And the market recovered entirely back to where it was. Then I think, the conventional wisdom is that the strategy for the administration was that they were going to work on the big, beautiful bill. And once that big, beautiful bill was passed, then they were going to go back to tariffs. So now the big, beautiful bill has passed. And it seems that, the day after it passed, here we are on Monday, the tariffs are coming back, or at least the tariff announcements are coming back. So again, if the tariff levels are increased and sustained, we can go through the mechanics of why, but that's going to be a negative force on the economy, domestically and globally. If these tariff levels are just the starting point, 25, and then they're supposed to go into effect August 1st, and then we're going to get to the end of July, and then they may get delayed. All of those things are up in the air. We don't exactly know how that's going to play out, but if the tariff levels are increased and sustained, that's going to be a negative force for the economy. The economy is already in a softening position, so that could propel the economy closer to recession faster. But it's an open question as to whether these tariffs actually go into effect. I don't know if anyone has any special insight into that.
One interesting phenomenon that we've observed both this time and in Trump's first presidency is that the CPI data didn't actually reflect overall higher prices as a result of tariffs. As you recall, back in 2018 when tariffs were announced and implemented, obviously not to the same scale as this time, but there were still tariffs and reciprocal tariffs on the US as well. The CPI remained relatively stable around 2 to 2.5%. This time was the same. Not only did the CPI not go up as some economists anticipated, it actually went down 0.1% in the last month. Can you explain why?
Yeah, so we never had the view that tariffs were inflationary to the broad consumer basket. And I think in some of our conversations that we've had in the past, we outlined that exactly. So when you impose tariffs, especially if the tariffs are on certain, localized goods, the price of that specific good may go up. But if the consumer doesn't have more money, they can't afford to pay higher prices for all goods at the same level of volume or quantity because there's just no extra money for them to do that. So if the consumer income level is staying unchanged, but tariffs are imposed, what has to happen is the price of that tariffed good may go up, but then the price of another good would go down to offset it because the consumer only has a fixed amount of money. And therefore, when they report the full CPI basket, it's not changed. Another possible outcome is the price of the good goes up, but the quantity purchased goes down. So you could have higher inflation and lower growth. But what we have seen so far is a little bit of a mixture of that. We've had a little bit of a higher tariff level that's caused higher prices on some goods. It's caused an offset in other areas, and it's caused slower growth. The latest numbers are something like 1% or 1.4% on the real GDP tracking numbers. So tariffs in isolation are not inflationary to the broad consumer basket. However, if we go back to the inflation that we experienced during the pandemic, that was caused by a huge increase in money supply. So if higher tariffs are met with higher money supply and the consumer does have more money, then they can afford to pay higher prices for all goods at the same quantity level. That would be the inflation that we experienced during the pandemic. But right now, the Fed is doing quantitative tightening still. The Fed is still holding interest rates at a relatively high level. Real money supply is not growing. So if you increase the tariff level, you're going to have an offset in prices somewhere else, or you're going to have lower growth somewhere else. That's why tariffs in isolation are not inflationary, and they're not going to be inflationary in the current monetary policy regime that we have as of this recording right now. If the Fed reverses policy, cuts interest rates, starts quantitative easing, and ramps up the money supply and tariffs go up, sure, then you can have consumers afford higher prices on all goods. But when you have a restrictive monetary policy, which we are still currently in a restrictive monetary policy regime, tariff levels go up, you're going to have offsets in other areas or lower growth. And we're getting both of those things right now.
Well, given what you've said just now about tariffs and inflation or the lack thereof of a relationship, do you think the Fed is making a policy mistake by waiting to see if data reflects higher inflation for the second half of the year before making a decision on rate cuts?
So I don't think that they're necessarily making a mistake because they have to adhere to their dual mandate, which is unemployment and inflation. Now, the Fed put themselves in a little bit of a predicament because what happened was if we go all the way back to before the pandemic, 2017, 2018, inflation was too low by the Fed's measure for too long. So what the Fed said was, we're going to let inflation really prove itself to be above 2% before we start raising interest rates. So just getting inflation to 2 won't cause us to raise interest rates. We really got to see it go to 2.1, 2.3, 2.4, and then we'll feel comfortable that it's above target and we'll start to raise interest rates. That really came back to bite them during the pandemic because inflation started to go up and they said, okay, we got to wait to make sure that this is real. And inflation ran away from them. And then they started to catch up. Then the Fed retooled their outlook again and they said, okay, we're not going to make any forecasts about the future. All we're going to do is take the data at face value. We've had a hard time forecasting things. Economists have had a hard time forecasting things. So we're going to take the data exactly at face value and respond only to the data. So if we do that, the data is saying that inflation is still above 2% and the unemployment rate is 4.1, which in face value is not a position where you can aggressively cut interest rates. The only case you can make to cut interest rates would be making a forecast about the future. Their forecast may be correct. They may be correct in cutting interest rates if the economy slows, but they said they're only going to look at the data at face value, which has been interesting because now they're making forward projections about what the tariffs may or may not do. So they've really put themselves into this box between saying they're only going to take the data at face value, we're not going to make forward projections. Now they're sort of making forward projections. If you take the data as it is, they don't have a huge case to cut interest rates aggressively. They can maybe get a quarter point or a half point off. My personal view is that the economy is slowing, monetary policy is restrictive, so they can actually cut interest rates. But admittedly, that is a forecast about the future, despite the Fed saying that that's not what they would do. So I think that they probably should continue to ease monetary policy very slowly here. They should continue to cut interest rates. But I'm saying that knowing that if you take the data at face value, is still not making a huge case for rate cuts. You do have to lean on leading indicators or forward-looking indicators to make that assessment about where monetary policy should be going. That's where I think they should be headed, but that is, a forward-looking statement.
Let's shift gears now and talk about the labor market, which I guess ties into your outlook about the economy slowing down. You wrote about cracks spreading in the labor market. I'll just read a few key paragraphs from the opening here. Under the surface, something has changed. You said that at first glance, the U.S. labor market appears to be strong. Cracks are spreading, and the underlying data is telling a very different story, one that hasn't yet made it into the headlines. In this post, we'll carefully walk through what's actually happening inside the U.S. labor market. I encourage you to check out the Substack that Eric has published here in more detail. But can you summarize your findings for us, please?
Yeah, sure. So when I say that the headline data looks good, that's exactly what I'm talking about, which is that the unemployment rate has remained flat for about a year, and the monthly non-farm payroll additions continue to be modest, 100, 125, 150,000 in that range. So when you take that face value data, things still look relatively stable. However, these are what we call coincident indicators. They tell you what's going on today, but they don't give you a lot of forward-looking statements about what's happening in the future. And if you click off of that chart and go down a couple, what I'm getting at in terms of what's happening in the labor market is a few things. Number one is that the prime age employment to population ratio and the prime age employment rate, which is the inverse of the unemployment rate, has been rolling off its cycle peak. And what you could see in this chart is every time it rolls off its cycle peak, you generally bump into recessionary periods. What's interesting about this particular period is that we've been rolling off this cycle peak for about 2 years without running into one of those gray recessionary bars, which is a little bit unusual. So we have a very slow deterioration in the prime age labor market, both the employment rate, the employment to population ratio, and the labor force participation rate. So very slow deterioration in the prime age employment rate, prime age employment statistics. If you click off that chart and go down just a couple of more, this is what we call labor intensity or labor intensity ratios. Just one more chart down, labor quality worsening, that chart right there. So this chart is showing us what we call the part-time ratio. And now this chart is inverted. So what this chart is measuring is of the people that are employed, how many of them are working part-time for economic reasons? When you work part-time, you can work part-time for what's called economic reasons or non-economic reasons. Non-economic is you're working part-time just because you want to work part-time. Let's say perhaps you're a single mother and you only have time to work part-time. That would be called part-time for non-economic reasons. Or
Yeah.
maybe you're a senior and you only want to work 20 hours a week or something like that, that's part-time for non-economic reasons. That's not what we're counting here. What we're counting here is part-time for economic reasons, which is you really want to work full-time, but you can only find part-time work. So what this chart is measuring is of the people who are employed, how many of them are working part-time for these economic reasons. So you can see it was 2.5, now it's 3% of the employed population. And again, when you roll off that cycle peak, generally you run into issues. So what we're seeing is companies are not really keen on hiring full-time employees, and people who want full-time jobs are having a more difficult time doing it. If you click off and go one more chart down, I'll close out this loop. The next chart that you're going to look at here is the full-time employment as a share of the labor force. So of all the people in the labor force, how many of them are working full-time? And again, you could see a very significant deterioration from the cycle peak. Granted, when we hit the cycle peak in 2022, that was an all-time high. That was when the economy was absolutely booming coming out of the pandemic. There was a ton of labor demand. Full-time employment hit a record
Wow.
high. But it's been coming down for 2 years, and we're now back at 2016, 2017 levels. We're back at levels that we're seeing, lower than they were at the peak in '07, lower than they were at the peak in '01. So all these things together are showing a very slow deterioration underneath the surface of the labor market, which is that companies are not hiring full-time workers with the same intensity that they used to. People have to pick up part-time jobs instead of full-time jobs. These are all things that companies do late cycle when revenues start to slow and margins start to compress and they start to do things to pull some levers to preserve those profit margins. They don't want to do layoffs because layoffs are difficult, they're binding, it's difficult to get employees back. So what they try and do is they try and pull these levers. They cut back on hours worked, they cut back on full-time employment, they shift to part-time. They do all of these small things around the edges that they can get away with for a period of time before moving to layoffs. And that's exactly what we see is that the hiring rate is extraordinarily low. If you don't have a job, it's very, very, very difficult to get hired right now. However, if you do have a job, we're seeing still a record level, low level of layoffs. So there's not a lot of layoffs, but there's no hiring at all. And the people who are getting hired mostly on part-time and jobs that they really are not ideally that they really ideally want. They want a better job or a full-time job. They're only getting a part-time job. What the unique part about this cycle though is this middle ground of this slowing of labor intensity. When you look back at this chart, there's very short windows where this throttling of labor intensity occurs before companies used to shift to layoffs and cause a recession. We're talking, 4 to 6 months where companies would shift to part-time work, cut hours, try and protect margins. It wouldn't work, and they would go to layoffs within 6 months, and then the layoffs, of course, would trigger a recession. What's been interesting about this cycle is they've been maintaining this middle ground, throttling this labor intensity for almost 2 years. And if you go to my last chart, I explain why I believe that this is happening. And it's mostly because most of the pandemic stimulus money ended up on corporate income statements. That pushed profit margins to an all-time high. And if you click out of this chart one more time, David, you can go down to the last chart of this, that one right up there. This is a microcosm of what's going on in the broader economy, which is the profit margin for residential home builders. Now, this is just one key example. This is happening across the entire economy. Before the pandemic, profit margins in the residential construction sector were about 10%. Stimulus money came in, economy was supercharged. Most of this excess money supply ended up on corporate income statements, and profit margins exploded, at least in the residential sector, to 20%, which was the highest level ever. In 2022, which is exactly when all of those labor intensity ratios peaked, profit margins started to compress. But normally, when profit margins would compress and they start compressing from 10%, companies only have a very short window before those margins go to 8, and then they have to really move to more aggressive measures like layoffs. But because profit margins got pushed to such an extreme level, companies started to throttle their labor intensity at 20% profit margins. The profit margins have since cooled, but they've only cooled down to about 15%, which is still 500 basis points higher than they were before COVID. So they're able to maintain this middle ground, throttling labor intensity, reducing hiring, but not moving to the recessionary layoff phase because they have such an embedded margin cushion. So what's going to happen over the next couple of quarters as the economy continues to slow, which it still is, you're going to continue to see profit margin compression. Tariffs could cause profit margin compression to accelerate. When profit margin compression continues and falls another couple hundred basis points, then we'll see companies move from these initial levers like less full time, cutting hours worked, and transition more towards the more aggressive layoffs. So that was a lot of information there, but overall, what I'm trying to articulate here is that the headline labor market statistics like non-farm payrolls and the unemployment rate remain stable and they remain in a relatively good place. But under the surface, we see all these late cycle dynamics in the labor market that are unfolding. They've been unfolding for an unusually long period of time, but they still are moving towards that recessionary dynamic. But what's been delaying the process is that companies have this huge margin cushion that has allowed them to really slow walk this process for about 2 years, when in the past it's been really like 4 to 6 months.
Just a few questions came to mind about the labor market data that you were presenting, and I'll come back to the housing market in just a minute after this part. I'm wondering how much of this decline is due to automation, whether or not people are getting laid off because of automation that's taking place or AI, and actually companies' productivities remain relatively stable because of automation. Is there a narrative around that, Eric?
It's entirely possible. I think the data is too premature to make that determination. When we look at things like real GDP per worker, not even per capita, but per worker. So are we generating more GDP with less workers? So the big thing with AI is people say we're going to be able to produce the same GDP with half the amount of people, right?
Yeah.
Something like that. If that was the case, real GDP per worker would double, right? Because if you cut the
Mm.
denominator in half, it would double. We're not seeing real GDP per worker increase at a pace faster than normal. It's actually increasing at the exact same pace. So I don't yet see it in the data that there's been this huge takeover of automation and we're producing the same level of GDP for less workers. That may happen. I don't see it yet. I see this more at the moment as a result of a lot of overhiring during the COVID period because labor demand was super high. The economy has obviously cooled off from where it was, specifically like things in the housing market, the Sun Belt area. And we're seeing a slowing of the cyclical sectors. The trucking industry has obviously been in tough shape for a while. Manufacturing has been in tough shape for a while. Certain pockets of residential construction have been in tough shape for a while. Those are the industries that loosen first in terms of the labor market. So I think this is actually just more a story of slowing demand. And companies just have a lot of margin cushion working off from the pandemic still. So I'm not convinced yet it's from automation, although we have to remain open to that possibility. And we would see it come through in data points like real GDP per worker, increasing at a hockey stick like pace if these projections came true, but we just don't see that yet.
If you take a look at some of these other labor charts that we talked about earlier, so this one, for example, prime age employment rate 25 to 54, do you think this is just a normalization of the prime age employment rate back to historical mean levels? In other words, maybe there was way too much overhiring post-pandemic. And I know firsthand there are some companies that overhired and they had to lay off because they just didn't budget properly. And now they're normalizing what they believe should be the equilibrium. And the labor market is just reflecting that. So it's not really that it's deteriorating. I mean, technically it is. It's just
Yep.
deteriorating from a level that had too little slack. Let's put it that
Yep.
way.
Absolutely possible. Absolutely possible. However, we use a few things to indicate whether the trend will continue or not. So this would be considered a coincident indicator, meaning that it peaks just about when a recession starts. Doesn't give you a whole lot of advanced warning of
Hmm.
recession. We would look at things like leading employment indicators to tell us whether this trend would continue going down or stabilize. And those measures that we would look at would be things like the quits rate, right? So are people voluntarily quitting their job because it's easy to go find another one? Quits rate is extraordinarily low. The hiring rate is extraordinarily low. Um, Hours worked are cooling off. So companies are still
Yes.
throttling the amount of hours that they're working. In the NFIB Small Business Optimism Survey, they publish things like companies' expected hiring over the next 6 months. That's obviously been coming down as well. So when we look at just broad leading indicators of employment, they're not cratering. They're not cratering towards recessionary or like collapsing type levels, but they're still slowly moving down. The same indicators that told us that the chart we just looked at was going to roll off its peak, those
Hmm.
indicators are still directionally moving down. So I would say that over the next couple of quarters, we're going to see that prime age employment rate trickle down slowly. I wouldn't expect it to fall off a cliff, but I would expect it to continue going down. So directionally, I think that we're still going in the deteriorating direction. Although, as you mentioned, it's not at alarming levels, and we are coming off very elevated, parts of the cycle.
Well, for those people who are still employed and not part of the unemployment section of the labor force, they want to know, well, we want to know how our wages will fare. So this is the Atlanta Fed wage growth tracker. Some economists tell me this is one of the cleanest trackers of wage growth out there for the U.S. It roughly correlates with the labor market data you presented, namely employment and unemployment. The real, or sorry, this is
Yep.
nominal, not real. The nominal wage growth has been trickling down from 6.7% now down to
Yep.
4.3%. Can you give us an outlook for this for wage growth?
Exactly. So this is exactly lines up with the data that we showed that the labor market was at its hottest or peak in 2022. It's been cooling since then. In nominal terms, it's still elevated relative to where it was pre-pandemic, but you hovered over the line there. It was about 4.2%. We got inflation
Yeah.
of about 2.2, 2.3. So real wages of about 2. This is kind of back to pre-pandemic levels. And then again, the question is, are we going to stabilize here or directionally keep moving down? One of the best leading indicators of wage growth would be the quits rate. The quits rate is still moving to the downside, so wage growth will continue to come down. Why is the quits rate a good leading indicator? Because if you were able to leave your job to go find a higher paying job, you would quit and go get the higher paying job. But if you're at your job and you cannot go quit and find a higher paying job, like let's say the job market is commanding lower wages than what you're currently being paid, you would not voluntarily quit. So the quits rate is like a confidence barometer of how how confident am I that I can leave this job and go get a better one? When that is moving to the downside, which it is, that's telling you that if you switch your job, you're not confident that you can get a better position. You might even get a worse position. So the prevailing labor market or prevailing, wage pressures in the economy are definitely cooling in the private sector, and that's evident of that quits rate coming down. So wages are going to slowly continue to compress over the next couple of quarters here.
Do you think Trump's policies surrounding trade will reverse this trend, at least in the foreseeable future in the next 6 to 12 months? Meaning, if we have protectionist policies in place and manufacturing does need to be brought back to the US, in other words, reshoring manufacturing, which is the goal of the administration, do you think that would force this trend line to reverse?
Unfortunately, I don't, because again, tariffs are tantamount to a tax. And in the final analysis, protectionist tariff policies increase the unemployment rate. So if you put up protectionist tariff policies, you are going to be shifting resources from more efficient means of production towards less efficient means of production that may result in higher prices for the goods being produced, which will result in lower unit volumes of those goods being consumed, which would ultimately lead to less employment or higher unemployment um, than lower unemployment. So again, all of this comes down to what are the actual tariff levels that are sustained, not proposed, not threatened via a letter. What are the actual tariffs that are imposed and collected? The tariffs that are being collected are far lower than what have been proposed. They are increasing. There's no question there, but it's not biting in a huge way because the actual tariffs being collected are still relatively small. So all this comes down to what are the actual tariff levels that are sustained and collected? If those are substantially higher than what we are, we're going to see negative economic consequences as a result of that. Now, I always want to caveat my tariff statements because I don't want to make it sound like I'm making political or partisan statements.
Sure.
There is a reasonable argument to be made, even more than just reasonable. There's um, perhaps even in a essential argument to be made that for some national security industries, tariffs are a good policy because we do need certain things to be made here that are critical for national security. I'm very sympathetic to that argument. However, just because something is done for the purposes of national security does not mean it doesn't still apply to the rules of economics. So you may say we need whatever steel to be made here for national security reasons. So we're going to put up large steel tariffs on other countries. That may be a good policy, but that doesn't take away from the fact that you're still producing steel in a less efficient way than if you were to produce it, in the global comparative advantage regime. So we can impose tariffs on certain national security type industries, and that could be a good policy in the final analysis. But that doesn't remove the fact that tariffs are a tax and tariffs ultimately move production from a more efficient place to a less efficient place. And you do have negative economic consequences of doing that. You just may feel that the national security benefit outweighs the negative economic consequence. If you put up tariffs on industries that are not sensitive to national security, it's not clear the benefit that you're getting from it, and you're just getting a lot of negatives. So tariffs, if they're not done for national security reasons, will have negative economic consequences. They'll still have negative economic consequences if you do them for national security reasons. You just may be more
Mhm.
comfortable with that trade-off.
So which sectors will experience more slowdown in terms of hiring, or I guess an acceleration of layoffs in the coming months?
Yep. So always the sectors that lead in the labor market are the cyclical goods-oriented sectors. So we're talking about trucking, manufacturing, residential construction, housing. Those
Mm.
are always the areas that lead. And if you look at those sectors, so I roll up an aggregate of, durable goods manufacturing, residential construction. When you look at those sectors, employment is down over the last 2 years in those sectors. So those sectors will continue to struggle. So sectors that always lead: construction, manufacturing, trucking, transportation, big cyclical heavy industries. Those are the industries that we want to continue to watch. They've been under pressure. They should continue to remain under pressure. And the way that that trickles through the rest of the economy is once there's enough unemployment in those sectors, those people who become unemployed are the ones that put the stress downstream on the more service oriented economy. Those are the people that stop going out to restaurants, they stop traveling, they stop going to hotels, they stop doing more discretionary type spending. And then that brings down the employment in some of the more lagging sectors that are bigger and more headline dominating.
I want to, for my last question on the labor market, and then we'll finish off on the housing market. I want to show you 30 seconds of this clip by The Guardian. This was published 9 years ago. Maybe you've seen it. It's called The Last Job on Earth. And I just want to, I just want to take a minute to maybe muse about what the future may look like as the people here at The Guardian have done. Here, take a look. I feel like I'm watching Minority Report. Anyway, this is a bleak vision of the future
It's a
where
pretty dystopian video.
a few people have jobs and the rest of us are waiting in line at the food bank. This is something that, is at the forefront of people's imaginations even today. I mean, this was 9 years ago, but it's even more relevant now
Yeah,
with the
impressive that
advent
was
of.
9 years ago. But yeah, it was pretty dystopian.
Anyway, I'll let you react to this.
Yeah, so look, I think that over time there's been innovation and changes. Um, we used to have a majority of our workers be agriculture, and that has
Mm.
shifted over time. And that can cause transient spikes in unemployment. But if the economy remains free market, um, workers will readjust and new industries will pop up. And those new industries will absorb the unemployed people. That's not to say that won't be transitory spikes in unemployment, painful periods, painful adjustments, but the economy has evolved over hundreds of years, thousands of years, and there are always new technologies that come and radically displace or completely destroy industries. And then that new technology, if it's more efficient, creates more disposable income in other areas, it creates new industries, and there's a reabsorption process that takes place. It takes time. There are obviously recessions and booms and busts that occur within them, but those are natural forces as a part of the economy. What I think our big risk is when these industries come and displace certain sectors, if we don't let that natural free market process come through and cause the unemployment, and then however long it takes, cause the reabsorption into the labor force, and the government comes in and tries to blunt that by preventing the unemployment and preventing that, creative destruction process, we do risk more of a stagnation type of a situation where you have kind of the worst of both worlds, where you have some innovation that comes in, but you don't have the benefit of the economy moving forward, the labor market advancing and retooling. So innovation is always going to happen. It's always occurred. We had people that were 90% of the workforce was agriculture. It's obviously just barely nothing now. That is a natural process that will continue to happen, but we have to let the free market process, take care of that. We can blunt some of the edges. It's possible to do some of that, and there's an argument over how much of that you should do. But the risk is if you come and try and blunt that force too much, and you have people that become unemployed as a result of innovation, and then you keep them permanently unemployed through government assistance or something like that, and those people never get reintroduced into the labor force, that's a more risky situation, one that will be, bad for society and also bad for just, overall innovation going forward. And, we have to be willing to let that free market process play out. So, yes, AI will disrupt jobs, technology will disrupt jobs, but new industries will emerge on the other end of that will require more employment. And the best part about technological advancement is if things can be done cheaper, that leaves more disposable income for consumers, more disposable income for companies. That disposable income will get recycled into a new industry. So there are benefits that will come. There's negatives, there's benefits. In the final analysis, the economy does move forward through innovation, but we have to let that free market process play out.
I think some people may overlook the fact that yes, maybe companies may become leaner in the future. I agree with you, by the way. Companies may become leaner in the future because we require fewer employees and staff to produce the same number of output, same level of output and number of goods. In other words, productivity may, in theory, increase as a result of AI and automation, and therefore we need less people in the workforce. However, that doesn't mean everyone's going to be laid off because there may just be more companies and more startups and more entrepreneurship as a result.
That's
Um,
that's right. And if you take
yeah,
your example of a company that becomes leaner, that means they're more profitable, right? If they're more profitable, that means the employees of that company will be getting more income, or the
yeah.
shareholders of that company will be getting more income. The people who are absorbing more income have more money to spend. If they're going
Hmm.
out and spending that money, their newfound money, that's creating new demand in other industries. Those industries will require more employment and more production as a result of that. So, there's a cycle that plays out here. And again, it's important to let the free market process unfold there. Again, what I think is the risk is if we have, spikes in unemployment as a result of some of this disruption, if we come in and blunt that creative destruction process, that actually causes, more problems and more risks.
Can we take a look now at the housing market? And we'll close off here, Eric. So this is it's from the BLS just a week ago released, July 1st. Let's take a look at what this data is telling us and how you're interpreting it. First of all, new home sales have been plummeting.
Mhm.
However, construction job openings reached 245,000 in May. Um, it's 3,000 higher than the previous month, but 130,000 lower than the previous year. So, industry-wide labor demand continued to be subdued in May. Job openings are down about 35% year over year. Layoffs, however, remain historically uncommon. In May, total hires reached 361,000. So we can see that the quit rates is actually kind of increasing in the
Mhm.
construction job openings market. Sorry, construction market, while the job openings continue to go down. Can you kind of explain this dichotomy and importantly, pair this with the fact that the home sales are kind of falling nationwide.
Yep. So, um, what I think is really important when we talk about construction is we got to separate the fact that there's residential construction and non-residential construction. Residential construction is a leading sector. Non-residential construction is more of a lagging sector. There are various reasons for why that's the case, but residential is leading, non-residential is lagging. When you put the two of them together, you get the total construction sector, and people generally say that the total construction sector is leading, and it is, but that leading nature comes from the pull of the residential. So what we don't see in this chart is how much of this is split between the non-resi and the resi. The resi we know is very weak, and that's where the job openings are really coming down, the quits are coming down. Non-resi is definitely stronger because of a lot of data center demand. I work with clients in the construction sector that do both resi and non-resi. We know that the non-residential is still strong because the data center demand is quite robust, but the residential is extraordinarily weak in the construction sector. So when you say the new home sales, that's residential, that's very weak. So I still see the residential construction sector um, having a softening labor market. We saw in the last report there was a very fractional decline in residential building employment. There's been declines in residential contracting employment. Those will continue to deteriorate. They will deteriorate because interest rates remain high, home sales remain low. Companies can't move their new builds. They're going to have to start lowering prices. That's going to cut into their margins, and we're just going to go back to that labor market loop that we were discussing in the middle part of this show. Some of those aggregate construction statistics still look okay because the non-resi part is still cooking pretty good. But a lot of that is really just data center demand driven by our seven companies that we know very, very well. So I think that the housing market is a sequence. There is the housing market, and the housing market being residential construction is a sequence. We have um, volumes, which are very depressed. That always moves first. So new home sales, existing home sales, very depressed. As the volume of home sales drops, which it has been depressed for some time, residential construction starts to slow. Because if you can't sell the units, you're going to slow down the construction. We're seeing that play out as well. As the construction slows, companies' profit margins start to erode because if you're carrying a lot of labor, but you're not really producing a whole lot, you're not doing a lot of new construction, your margins start to compress. We're seeing that too, but they still have some cushion. That's going to continue. Margins are going to continue to erode further. As margins erode further, then you're going to get companies that have to relinquish some of their headcount. When they relinquish some of their residential construction headcount, that's when we're going to start to see the labor market start to deteriorate in a way that starts to reach the headline numbers a little bit more. That's
Mm.
exactly where we are in the cycle today. We're stuck in between that kind of phase two and phase three of that sequence. Phase one being volumes, phase two being construction activity, phase three being the dynamic between margins and employment. Once that phase three kicks in, labor market starts to deteriorate, layoffs occur in the residential sector, then you're going to see it in the headline numbers, but we're not quite there yet. So that's kind of exactly where we are. That's what we talk about at length in a lot of our recent reports that we've been doing.
All right. Fantastic. Thank you very much. Very thorough analysis. Where can we find out or learn more from you and read about your work?
Yep, just go to epbresearch.com. You can also find me on X at EPB Research. You can find me on Substack. But epbresearch.com is the place that you can find all of our information and the services that we offer for institutions, um, high net worth, as well as companies in the construction manufacturing sectors.
Okay, thank you. We'll put the links down below, so make sure to follow Eric down there. He also has a great YouTube channel. So thank you very much, Eric. Appreciate you coming on the show, and we'll speak to you next time.
Thanks as always, David. Appreciate it.
Thank you for watching. Don't forget to like and subscribe.